Welcome to the 1031 Exchange Passive Income and Investment Series. This show is brought to you by 1031navigator.com. 1031 Navigator is the best way to plan, execute, and complete your 1031 exchange with peace of mind and confidence while saving you both time and money.
Hey everybody, Thomas Morgan here with 1031navigator.com. Hope you're having a great summer. The podcast has kind of been on a hiatus for the last little bit. Had a busy spring and then went on a little vacation in June. And then July has actually been a pretty hectic month with the forest fires. On July 3rd, a few miles from my house, some idiots were shooting some tracer rounds at the shooting range with a stage 2 fire restriction. So one, the shooting range shouldn't have even been open. And two, they definitely shouldn't have been using tracer rounds. And they caught a couple trees on fire. And within an hour, 300 acres were on fire. And within 24 hours, 3,000 acres were on fire. And here we are into July. It's called the Lake Christine Fire, just outside of Basalt, Colorado. If you do a search for hashtag Lake Christine Fire, you'll get some pretty amazing photos, but they had to bring in anywhere between 400 and 500 firefighters and helicopters and DC-10s. And my house was on pre-evac for several weeks during this fire, and they finally have it under control. And all the, of course, mandatory evacuations have been lifted, and the pre-evacs have all been lifted as of yesterday. And so I think they have a good handle on it, but gives me real sympathy for the big fires in California right now, sympathy for the people who have been dealing with the hurricanes and flooding. It was really unsettling for the last month with kids and animals in a house and, horrible smoke every day. Came and opened the windows, ash all over our furniture, and just to see that smoke plume every day. And, luckily the firefighters did an amazing job. Really proud of them and what they do. It's really amazing work. And I can't say thank you enough, for them. But so it's been kind of a weird, summer out here in Colorado, and, hope everyone else is doing well, but we're getting back to normal. And I have a really exciting, episode today, which I recorded back in the spring, kind of before vacation and before the fire. And rather than me just rambling, one person in front of the microphone, I'm pleased to have a guest on this episode. I also have a little motivation. I'm having lunch with the guest later this week here near Aspen, and I want to get this episode out to the airwaves before we have lunch. I really appreciate his time. Today's guest is David Sobelman, and we cover a lot of his bio and different ventures into the triple net and 1031 space in the episode. But briefly, he is the founder of Generation Properties, which is a triple net real estate investment trust, which is getting ready to get listed on the New York Stock Exchange. He is also the founder of Verum Properties, which is the first net lease valuation tool. We talk about that in the episode. And he is also the founder of what is called 3 Properties, the numeral 3 Properties, which is a triple net leased investment brokerage firm providing national net lease brokerage services. He is the author of 2 books. One is The Little Book of Triple Net Lease Investing, and the other one is The Little Book of Urban Net Leased Investing. David is a true expert in the field of obviously triple net and net lease investments. And the episode conversation was really fun. I could have talked to David for hours, and I'm excited to have lunch with him later this week. But there's links to all of his companies and ventures in the show notes, and links to the books in the show notes as well. But in the episode, we cover a bunch of different things. And I think you're going to find it super helpful. And we talk on just general triple net terminology and strategy and risk and pitfalls and a bunch of different jargon, and even go into some more advanced strategies, different types of ways to invest, such as DSTs, buying stocks in a REIT, we run different real life scenarios with different amounts of capital to invest and different investor profiles and risk profiles. So I think it's a super helpful, informative episode, and I had a lot of fun doing it. And as a side note, we use an example deal in the podcast where we talk about a $1,500 per square foot example. And that property is a Starbucks in Florida that Generation Income Properties purchased a few months ago. And we kind of use that as an example. And David said that was a ground up. It was a scrape, and they scraped the old building and they built it ground up. Starbucks really wanted the location, and Starbucks was purchased for a little under $3.5 million, which was 14.5% below its appraised market value. So I just wanted to give you that color on that deal when we talk about it. And that's the $1,500 per square foot example. So without further ado, thanks, and talk to you soon.
Hey everybody, Thomas Morgan here with 1031navigator.com, and today I'm doing something a little different. Rather than me just blabbing to the microphone, I have David Sobelman on the line, and I'd like to introduce everyone to David. David, how you doing?
I'm doing very well. Thank you so much for having me.
So David's list of accomplishments and things he's up to is almost too long to go through here, but I think we're going to touch on a lot of them, including his history and the different projects he's working on in the triple net and 1031 space. So I rather than going through a rundown, David, of all the different things you're working on, I thought we'd just discuss them on the call. But the first thing I have here is I'm holding in my hands a little red book, and it's called The Little Book of Triple Net Lease Investing. And I wanted to just read something from the foreword. The first couple sentences says, "Welcome to the only book you'll ever need to read about triple net lease investments. And while we may be in the business of selling such investments, we assure that our fiduciary responsibility to our clients comes first." And David, the reason I read that is, that's the reason I do the podcast. I treat all my relationships and, clients with kind of a long-term view of who they are, and that eventually I'll be dealing with, their wives and kids and hopefully grandkids. And, so I think, your book and what you're doing really goes along with that. And I just wanted to kind of start there on the book. Tell us why you wrote the book. And it's actually, I know it's gone to a couple different versions, and you even have an additional book with the urban format.
I do. Yes. So we have 3 books now. And that's how granular we're getting with triple net lease investments, even though they're a niche within commercial real estate. We've kind of figured out that there are sub niches, and so I just enjoy writing to start with, but it's really just an easy way to connect with the market overall and to educate an entire population of people who may or may not know that these properties exist altogether. So the impetus of writing the first version, very frankly, was because we were at the depths of the last recession, and I was sitting at my desk and not having a lot of work to do.
No deal to do, right?
And just decided that, instead of me having a phone call or a meeting with someone to explain the property type, that I would just write it. And so I wrote that very first book as a basic understanding of triple net lease properties and how you look at them from an underwriting perspective. And it was the first time it ever happened, and I just couldn't believe it when I did my initial research that no one's ever tried to memorialize what these assets are other than, maybe a paragraph here or there. I think I found a research paper from 10 years earlier from some educational institution, but never just a book in itself that was informative, lighthearted, not super finance-oriented, where we're getting into spreadsheets or anything like that, but just a basic overview of what the property was like. And so that was really the reason, twofold. It's never been done before, and I had the time to do it.
Right. And it's funny, a lot of deals I've done, people are first-time triple net buyers, or even their attorneys have never worked on a triple net deal. And so they start doing the due diligence, and they think they need 90 days to review the leases and do environmental research and whatnot. And your book actually covers a lot of the due diligence process. It has sample purchase agreements, sample leases, sample letter of intents. And I think it's a really great primer for anyone, even experienced people. I think I could hand them this, and they would learn many, many things that they don't know.
Very much so. That was one of the main drivers is to truly try and standardize the industry overall. Not like I'm the dictator of net lease properties, but there are so many different ways to look at any one real estate asset, let alone a net lease property. Even the various nomenclature that goes in the use of what a triple net lease is, that varies between investors and attorneys and lawyers and underwriters and lenders and anyone involved. I think at one point I figured out you can have up to 23 different parties involved in any one transaction. And if they're all using different words for what can ultimately be the same thing, that just gets really confusing. So this was an opportunity to try to aggregate all of this information in one place and allow people the chance to just really understand the property type and use the same lingo or language.
Right. It's funny. You were a broker for what, 12, 15 years before doing what you're doing now? Yeah. Technically, I'm still a broker. I have licenses in several places. So, yes, but I was a full-time broker for 15 years. 15 years. And it's funny, my mom called me after the holidays, and I was just talking to her, and she was asking how business was. And I said it's good, and I'm doing a lot of deals. And she goes, well, tell me again what it is you do. And I told her I'm working on Walgreens and CVS right now. And she says, oh, do you sell the business? And I'm like, no, Mom, I don't sell Walgreens the business. So when people over your career, when people have asked you, what you do, or even now, and they ask you what you do regarding triple nets, what's the elevator pitch?
Right. Yeah. So and just to make you feel better, my wife ultimately didn't know what I did for this first maybe decade of my career, and she spoke to me every day, and ultimately how I explain it to my wife or clients, investors, even counsel on different transactions, different lenders and so on is a triple net lease property is where the tenant, not the landlord, the tenant is responsible for the taxes, the maintenance of that property, and the insurance. Hence the three nets, and that's really the simplest way to explain it. But most people don't really grasp what that truly means at the end of that sentence. And so I like to give an example of it. And so I say, well, everyone knows their neighborhood Walgreens drugstore. And then you watch someone start nodding, and they say, yes, I know what that means. And I say, well, listen, you have a very specific building that's on one parcel of land. There's one building. There's one tenant in that building, and most people don't know that Walgreens, in this case, doesn't own their asset.
Right.
They own their building. They lease it, and they operate under a triple net lease, which I just explained to you. And so you can purchase that asset, or someone can purchase that asset, and with the tenant and the terms of the lease in place. And so when I explain it that way, in a very simplified fashion, again, just a very, one or two sentences about what a net lease is, and then an example afterwards, then the conversation truly opens up, and people start thinking about all the different types of single-tenant buildings, primarily single-tenant buildings that they use on a daily basis, but they've never really thought about it from a real estate investment perspective. And then they start getting into, oh, that's like my bank, or that's like my grocery store, or that's like my office building, because our company is just one tenant, and I know it had a landlord, but I didn't realize it was a triple net lease, or an industrial property, and so they start applying these, very simple words into the application of the real estate investment themselves. So if you're a true novice or someone who's almost a neophyte to net lease investing, that's a good way to explain the industry itself. And then depending on someone's level of sophistication in investing and just real estate overall, you can get much more granular.
Yeah, and in addition to all the things you pointed out and explain to people what it is, but one thing that catches people's ears, if I'm at a dinner party or school event or whatever, is you say I sell essentially investments that are mailbox money or armchair investments, and all of a sudden the doctor I'm talking to will lean in and say tell me more.
Yeah, I'm a little. You're right. That's correct. And in the vast majority of cases, that's why people like the investment type overall. But I always caution people, just because I'm conservative in the way I explain these things
Sure.
and how I invest, and I always say it's still a real estate investment, and things happen, and you just have to be prepared for that. So even if your tenant is there for 20 years and you've not gotten one phone call for that entire 20 years, it's been the greatest investment experience of your life. If they haven't been doing what the lease tells them that what they should have been doing, and they end up vacating that property, you still own that property and everything that comes along with real estate ownership. And so everyone says it's mailbox money or passive or someone. It's really not entirely accurate. You still want to make sure the tenant's doing what they're supposed to be doing
Yep.
during their occupancy. And that means, looking at the property or following the credit worthiness of the company, or, going back and reviewing the lease and making sure that you understand all the different terms, during your ownership once a year or something to that effect. So yes, you're right. You're not fixing toilets or changing light bulbs or, getting those phone calls, but you still own real estate. And I always make sure people understand that. And if they're not the ones to kind of manage their asset, and I chose my words carefully there, they're not managing the property, they're managing the asset.
Sure.
If they're not going to be managing that asset, then to hire someone to do it. Just to make sure that it's all done. And my firm has that service where we can manage people's net lease properties for them.
Sure. And I think your point about that it is still a piece of real estate, and at that, it's not a residential piece of real estate, it's commercial real estate where, roof might be $50,000 or, parking lot might be $20,000 or, depending on the size of the property. So one thing I always tell people is I call myself a real estate guy, even though I'm selling credit rated tenants who are backing the lease and, paying the rent. At the end of the day, you have to look at the real estate fundamentals. And I think your book does a very good job of you said at the beginning, it's an objective book about, our job is, we're selling the investments and the deals, but we're, at the end of the day, we're selling the real estate and covering, some of those metrics of like, it boggles me, and I'd like to get your input, but when, someone pays $1,500 a square foot for a fast food, place where there's not that many tenants you can put into it. I think there's a lot of demand and, rationale to buy a fast food restaurant, with a recession economy or, what's happening with the internet, things like that. And maybe, if the parcel is big enough and the building is the right size. But what are your thoughts on, some of the net lease deals where the real estate fundamentals just, don't make sense, where, the dark value or the residual value just isn't there?
Mm-hmm. So just yesterday, the REIT that I run, real estate investment trust that I run called Generation Properties, purchased a Starbucks asset that fits right in line with your example. We paid roughly $1,500 a square foot. And to your point, you're saying that that's, just regular construction costs could never get to that rate, or at least they're not at those rates today. So why did I end up purchasing it?
Sure.
I'm comfortable purchasing that asset. Number one, because I have an investment grade credit tenant in Starbucks for 10 years with no options for them to terminate that lease. So they have a Standard & Poor's credit rating of A+. And if you look at like a Moody's scale, the probability of them defaulting over that period is something like 0.4% chance of any 5-year period. So
sure.
Since their credit rating is what it is, the probability of them defaulting over any 5-year period is extremely low, essentially zero. Because of the type of company that they are. So that's number one. So whatever the income is on that asset, I feel very confident that I'm going to get that income for that
right.
10 years at least. So that's number one. Number two, I was very confident in the real estate fundamentals. So you mentioned that prior to this. Well, this asset was what we call a raise and rebuild. Raise is R-A-Z-E.
Right.
And where there was an old building there for 50 years. It's in the middle of the location, the town that I bought it, city that I bought it. Very hard to develop in this area. The land value in itself is extremely high. And I'm not counting the tenant credit. I'm not counting the building that's going to be built there. Just it's hard to own an asset where this Starbucks was built. And so even though I paid $1,500 and construction costs were not even close to $1,500, I know that the land value in 10 years is going to be even higher than, well, I can't say that I know, but there's a very high likelihood that the land value is going to be even higher, irregardless if Starbucks is there as a tenant or not. So the reason that I was comfortable paying this $1,500 a square foot was because of the real estate. And so in my books and as I talk to clients and as I purchase assets, I always put real estate as the first underwriting fundamental that everyone should focus on. Just the very traditional, where is your property? And that is something that I think gets away from a lot of net lease investors because they're so focused on the second underwriting criteria, which is the credit of the tenant. You know, who is going to be paying your rent and how long are they going to be paying it for? So some people buy assets not really caring where the asset is because there's a credit-worthy tenant paying them for whatever duration of time. So in my case of kind of overpaying for the building value, I knew that, or again, I should have said, I have a very high likelihood of that asset appreciating over time, and I just so happen to be getting income from this great credit tenant.
Well, in a couple of things to your point is, or your points is, if you're buying in the middle of nowhere where there's not many people or demographics, like some dollar stores are that way, or a declining population, high unemployment, then these things, it goes back to location. Like, so when you spend $1,500 a foot, I suspect, knowing Starbucks, there's super high traffic counts at the location, I would assume, and that Starbucks usually has generally good access of right in, right out, or lighted intersection where people can circulate, and I suspect there's a drive-through there as well.
Right. That's exactly right. So again, just looking at real estate fundamentals. So let me just explain to you how nerdy I am with net lease property. And so we've been discussing some of the fundamentals that we use to underwrite value of the property. Some of them are very quantifiable, like how much it costs to build. What your construction costs. How much does the land cost? You have a very specific value. You can look at a credit rating agency, and you can get an understanding of the credit worthiness of a company. That's not truly quantifiable, more qualifiable, but it's getting you close to finding value in an asset. But what I've always struggled with in my careers is there's a tremendous amount of subjectivity in valuing a net lease property or any real estate asset.
Yeah,
for that
absolutely.
Yep. You really just feel as if you say, well, this is a good market. Well, why is it a good market? And what are the actual value indicators in there? So, for instance, you brought up access. Like, well, that's good that it has access, or it has good access, or even great access, but how does that translate to a dollar value? How do you monetize the access? Even more quantifiable aspects of demographics or traffic counts. These are true numbers, but how do you translate those numbers to dollar value? And so ultimately, I brought this idea to a university professor who's the head of the real estate department at the University of South Florida, where I live here in Tampa. And we got a grad student involved as well. And the three of us came up with an algorithm, a formula, on how to look at any one net lease property. Ultimately, we determined that you can have up to 192 different variables that go.
And is this, David? Is this Verum Properties?
This is called Verum, right? So Verum
right, okay.
is Latin for the truth, and so we named our algorithm Verum, because we feel like we're getting a true and accurate assessment of the value of any one net lease property. So we can put up to 192 different variables into our formula, and out comes one number, a cap rate. And it takes into account not just what the rent is and what city it's in and what the length of the lease is, but it gets extremely granular on the underwriting of the asset, and it's really helpful to determine value on a net lease property. So we enjoy using it.
Are you going to be making that public, or will that be a service people can use?
Yes to both of those. Yes. It's going to be in constant development, but just to give you, again, we like to be specific. So our algorithm, Verum, has a margin of error of about 6.5% right now. So for some context of that, an appraisal has anywhere from, let's say, and I'm being generous here, between 10 and 15% of margin of error. And so an appraiser will openly tell you that we have between 10 and 15% chance of getting our number wrong. And we're telling you that our calculations are better than an appraisal by a minimum of 3.5%. Ultimately, we feel like as we continue to develop the algorithm, we'll get down in the 3% range, and we're hopeful to do that this year. But we can value net lease properties not just more accurately, but more efficiently, more cost effectively, because we all know an appraisal is expensive and takes a long time, and they're using comps or comparables. And what are comps? Comps are transactions that happened in the past, and they may not be directly next door to the property that you're valuing. Even the property directly next door will have a different value than the property that you may be purchasing. So we feel like you have to get very specific to have an accurate number on value for any property.
Yeah, I couldn't agree more. And as an example, one of a really good client of mine, I work with all the kids now, and in his CPA, he passed away. The principal passed away a few years ago, and I helped the family with gathering appraisals on I think it was like 14 triple net properties all over the country. All different markets, several different tenants, and we waited anywhere from 3 weeks to 6 weeks to get 100-page appraisals. And each appraisal was anywhere from on the cheap end, I think the lowest one was like $2,500, and on the high end was like $6,000 per appraisal. And for estate purposes, that's fine if the value comes in lower. But I couldn't believe when you go through each appraisal and you look at the properties and you look at the comps they used, it was just amazing to me that they just, even MAI appraisers, just a lot of them don't get the net lease business or cap rate valuations or the location dynamics of what goes into the value of a property. I think
completely agree. Yeah, go ahead. I'm sorry.
Yeah, no. So Verum, what you're talking about from a broker standpoint, or I kind of think what comes to my head is like Zillow of like net lease properties is essentially what you've created.
That's exactly right. And when I talk to colleagues who are appraisers, they openly admit that they're hamstrung in their process. They openly admit that, comps are not the best way to value a property, but it's their only tool. And additionally, it's from a regulatory perspective, especially when you're dealing with a lender, you're required to have an appraisal because the banks, want to make sure that they're complying with the regulations. So there's a lot of negatives to an appraisal, but it is what's most
it's the standard. Yeah,
right. I think that'll change over time as we continue to develop this. Appraisers also struggle with the fact of our earlier point of having $1,500 per square foot because they don't understand a net lease valuation as well. They're looking at it strictly from just a real estate perspective, and they're not folding in the fact that there's a credit tenant who's in there, valuing it for 10 years and on and on and on. So there's lots of struggles that appraisers have. They understand that they're hamstrung. They try to do the best they can, but they realize that they have limitations, hence their margin of error being greater.
Sure. And so, going back to the $1,500 a square foot, when I brought up that example, my perspective is, most of my clients are private individuals, medium net worth or, even some low net worth. And then I work with a lot of high net worth investors who might have 20 or 30 or even 50 properties as well. But most of my clients are private individuals and families. And so I call that investor profile. Whereas, your example, and that's why I would like to talk about generation income, is your investor profile. When you bought the Starbucks, paying $1,500 a foot, you have different goals or to a certain extent, and a different risk tolerance than someone who might only have a $5 million net worth and they're putting $2 million in a Starbucks. It really changes the dynamics of the investor profile. So tell us about, I assume you were buying that Starbucks with Generation Income Properties?
Correct. Yes, that's correct. And our philosophy is to buy and hold. So we're not property flippers. We're not in properties for short periods of time. Typically, we give ourselves the option to be or to have flexibility in our acquisition and disposition process, but typically we buy and hold. So the real estate fundamentals of any one asset is a primary concern to us. And so yes, there is a certain amount of scale within your personal portfolio that most people should have prior to purchasing an asset. I've worked with plenty of people in my career who have pooled their resources with friends or family or partners, and there's other ways to invest with others in order to get a net lease property that's accretive to everyone's portfolio. But ultimately, there is a certain amount of liquidity that someone does have in their personal portfolios.
Sure. So tell us about Generation Income Properties and what you're doing with that.
The REIT is a public company. So you can go on the SEC website and search for Generation Income Properties and see all of our filings. And the impetus of the REIT was just based on my experiences by being a net lease broker for so long and selling a lot of properties to net lease REITs, along with other individuals and other types of entities. But ultimately, I saw an opportunity where most of the net lease REITs, and currently there's 14 other net lease REITs that are all currently trading on the New York Stock Exchange. So Generation Income Properties is the 15th net lease REIT. Of the 14 of them, I believe 11 of them have $1 billion market cap or greater. And almost all of them has started where I am on a small scale. They bought one property and then they kept growing their portfolio. In any case, I saw an opportunity amongst all the other net lease REITs because they all have their own strategy of how to grow their portfolios. So some REITs are retail properties only. Some are industrial properties only. Mm-hmm. And some are credit companies only, credit tenants only. Some are non-credit tenants only. And there's just a lot of different ways that the strategies of these REITs were coming into play. And what I realized is that of those 14, none of them were focused on increasing the value of their real estate. And what does that mean? So, ultimately, they'll buy a net lease property and they'll collect the rent from the tenant and they'll pay out the dividend to their shareholders. And, everyone wants to be able to do that for as long as possible. So they're putting, from an underwriting perspective, the credit of the tenant first, before the real estate value. But if the real estate value increases during your ownership, then that can be reflected in the net asset value of the company. So now we're getting into securities. And typically when the NAV of the company increases, the stock price goes along with it. So I get the question a lot of, when you're buying a net lease asset and you have these contractual rents for decades, literally, how can you make money as properties appreciate? Because the rent is set and you can't change it. Typically, you can't change it. And the answer is by having a public vehicle in which you can invest in net lease properties, which is what my REIT is. And if you focus on the real estate fundamentals, then hopefully the properties increase in value. Subsequently, the NAV increases along with it because that's what the REIT's assets are, is the properties.
Mm-hmm.
And then the stock price traditionally goes up along with the NAV. So if there is a focus on increasing property values through a net lease REIT that just so happens to be getting income from these great credit tenants for long periods of time, then you might have a chance of having a growth stock as opposed to just a dividend machine.
Right. Yep. Just the cash flow.
And I'm not saying that from a negative connotation whatsoever. Because a lot of people invest in these net lease REITs because they just care about the dividend. That's solely what they're focused on. But I'm choosing to have both a dividend and the potential for growth.
I have clients that call me and they want one thing, or two types of clients to a certain extent, where they want just income. They have a big portfolio, they have other assets, they're old enough in their life, and they say, Thomas, I don't care about the value necessarily at the end of the lease. I just want 5% or 5.5%, whatever their yield is. They just want the income, and that's what a lot of people who buy the Walgreens and in CVS end up doing, is they're not really worried about the dark value or the residual value or the value increase in the real estate. Whereas on the flip side, I get people who are new to the business or people who are in their 30s, 40s, 50s, and they're trying, different stage in life, and they come to net lease and they think they're going to be able to it's like traditional real estate investing, like, the real estate always appreciates. And I say, well, no, it doesn't. And that's one of the biggest risks of triple net properties, is that the value at the end of the lease, might be the same, might be less. I mean, might be more depending on what property and, how long you've owned the property and, what market you've owned in. But I think the two things you're talking about with the stock coincide more with a traditional type of real estate investment where you invest for cash flow, but you also invest for some kind of appreciation.
Mm-hmm. Very much so. Yes. Yes, you're exactly right. If there's always a motivation behind the investment, and you summarize those nicely. So you have some professional investors or developers who think a 5% return is ridiculous. They would never accept that return.
Yep.
And you have other people who say, I would love to get 5% and never have to do anything. That's the greatest return I can get. They'll have the comparison as to why that's great for them. So you're exactly right. There's different motivations to purchasing a net lease property, and cap rates, they really don't fluctuate that much. I mean, my first real estate job was at the lowest level of the firm, which was a research analyst, and I've never forgotten those traits of looking at the numbers and making sure you're making good decisions based on data, and so the net lease market overall, over a long period of time, let's just kind of summarize and say the last 20 years or so, hasn't fluctuated drastically from a cap rate perspective. There's probably about 300 basis points between the depths of the recession and the peak of the market. And most...
And real quick, for my listeners who don't know that, so 300 basis points. So with what you just said, I would say right now we're at, let's say, in a 5 cap market, or we were in a 5 cap market, and then 300 basis points would be make it an 8 cap market, which, I was doing deals in 09 through 11 in the 8 cap range. And so that's basis points. I just want to explain that.
Yeah, right. 1 basis point is 0.01%. And so 100 basis points is 1%. And so there's roughly a 300 basis point variance between the depths of the recession and the peak of the market. In most investment vehicles, that's a very narrow window. So there's not a lot of fluctuation, even in the worst of times. But it still goes to the value. So you have to understand that a cap rate by nature is a measurement of risk. And so the lower the cap rate, typically the lower your risk. Mm-hmm. And then we can get into an entire discussion about risk, but that's ultimately what it does. So those who are buying net lease properties strictly on the return in which it provides, they have to be comfortable with that outlook of their investment, even if the tenant is not there. And so they have to make sure that they understand that this is still real estate. And if they have a vacant property, what's the probability of them finding a new tenant, redeveloping the property? If there's a loan on the property, can they service the debt if the tenant's not there? And any other metric or outlook that we take.
Right, and those are all things. If some of my listeners go back to previous episodes, David, that's something I really try and harp on with my folks and clients as to what is the value going to be at the end of the lease, and what could you do with the property, and if you have a balloon, on a loan in a raising interest rate environment, what does that do to your risk level? What happens if the tenant leaves and you have a loan? What happens if you don't have a loan? What are the property taxes? Things like that. So that's a whole nother discussion on risk. But I think your book does a really good job of covering that. And I hate to say it, but a lot of triple net brokers I deal with, and even investors. I mean, if they have deep enough pockets, it's fine. They can weather the storms, but a lot of people can't. And so I look at it from a standpoint of, okay, if my family or my brothers and sisters, my in-laws or whoever is buying a property, and my niece and nephew have to deal with it 20 years from now, what's that going to look like? And yeah, they might have got good income for 15 years, but what happens if something does go wrong? So I think your strategy with driving real estate values is unique and important.
Thank you. Yeah, I appreciate that.
Yeah. So on Generation, are you offering obviously stock shares on the stock exchange? Are you offering? Do you have a DSP program also? No. So we don't. We don't have Delaware statutory trust investments. I do work with a lot of DST sponsors who, they're investors maybe looking for an exit mechanism for themselves, and they can essentially upreit their property into generation income properties, and then what ultimately happens is that property is, for lack of a better term, traded for shares of the REIT. And, sure.
And now instead of being in one property with several other investors, now everyone has a pro rata portion of shares that they hold in their accounts, and they can then keep them and continue collecting dividends from a more diversified portfolio at this point that's managed by an experienced owner. Or if there's a chance to sell their shares, they can do it on the open market because they're controlling those. So that's different ways to use the REIT for both investment purposes, direct investing, and to upreit properties. So
so at this point, there's no way for a 1031 investor to invest in generation income.
No, they need to use just non-1031 capital to invest in shares directly, and they do that directly through our company at this point. We just started the process to become a listed company. So again, we'll be the 15th net lease listed net lease company. And so that will probably be in the next 2 or 3 months or so. But so if people are interested in investing in Generation Income Properties prior to our listing, then this is the window to do that. But those who have an exchange who want to invest in the REIT with the exchange funds, that we're not set up to do that. I don't believe any REIT is really set up to do that.
And could you, as a REIT, can you be a sponsor of DSPs, or you have to be, that's more of a private company situation?
Yeah, that's more, there's an entirely different ownership structure to that one asset through the DST process or tenant in common process, whichever vehicle you're using. And so our REIT doesn't engage in those types of ownership arrangements.
And the reason I ask, I'm sure you've dealt with this a bunch, is clients have excess 1031 money, or their capital might be too low to buy a good net lease property, and so I'm always trying to find good alternatives for 1031 exchanges that aren't necessarily buying a property, standalone property. And so far the only way I've seen to do it is a DST or a TIC. Situation, unless they want to go into a totally different, and unless they want to go into a totally different asset class, essentially, and stay out of single tenant properties, depending on how much capital they have.
You're exactly right. There's a reason why a 1031 exchange is so restrictive on not only the types of assets or the methodology in which you can invest, but also the time frames, of course. And they just want to make sure that if the federal government is giving you a break on deferring your capital gains taxes, that you're putting that money to work as fast as possible. And so, there's a narrow window, a small window of what you can invest in, and then the time frame in which you can invest.
Right. So on one last thing I wanted to touch on before I'm going to ask you a bunch of what I call fun questions, and I'd like to just, I think it would summarize all your experience nicely. But one thing I wanted to touch on before we do that is three properties, your brokerage, and if you could just tell us all about that.
Yes. So I have seen that a lot of brokerage companies, and I say this with the disclaimer that, I've been a broker for 15 years. They're very inefficient models. And I say that with the utmost respect because it may work for them, but I just always felt like the brokerage model is an inefficient process that really is funding primarily the companies and the broker, the ultimate broker, especially in larger firms, they typically only get about half the fee in which they're paid, because the other half has to go to overhead and executive salaries and so on. And so I just felt like net lease brokerage lended itself very well to have a much more efficient model, one in which the brokers don't have to have a tremendous amount of expenses because, and you can tell me differently, but you probably very rarely sit in front of your clients. You're probably doing most of this by email and phone, and occasionally there's a video call. And most of the time, the people could care less where you're sitting as long as you're an intelligent person who performs well and knows their market.
Right.
And I found that most successful brokers operate that way. And so if you just happen to be good at net lease brokerage and you have a good reputation and you can provide a nice deal flow for your clients, you typically don't want to pay out half of your fees to things that you're just not using. And so we've structured an entire business model that is a very efficient and streamlined company that's great on marketing, and it's great on access to resources for the brokers, tremendous amount of research, the ability to use our proprietary algorithm, and just a lot more of the resources that brokers need but they don't necessarily need to pay for. And so ultimately, the client benefits from that because they're working with the highest caliber of brokers, but they typically pay less than what they would a traditional large brokerage firm. And that's only because the company's costs are less. So it's a pretty simple business model, but one that I've embraced nicely, and all the brokers here seem to love it. So our brokers make more, our clients pay less, but they get the exact same results.
Yeah, and you're absolutely right. That's, as you and I discussed, and I live here near Aspen, and my clients are all over the country and sometimes all over the world, and they don't need to meet me in person, and very seldom do I meet them in person. It's all phone, it's email, and as long as I'm communicating and doing a good job, that's what they want. They want someone who's responsive and efficient and watches out for their best interests. And I think that's essentially what you're saying about your brokerage.
Yep, that's exactly right.
Okay, so David, on to what I call kind of the fun part, and I'm not going to hold you to the answers because it's going to kind of be rapid fire. But I think the listeners all gauge that your level of experience and expertise and professionalism. So I'm just going to rattle off a few different scenarios and kind of questions, and then you just kind of give me a couple sentence answer, and then we'll move on to the next one.
Sounds good.
So what do you think the biggest risk for triple net investors is right now, or someone who's looking to buy a triple net property? And if there's one main risk that kind of pops out, if someone, when they're looking to buy a property, what should they be watching out for?
They should look at where the property is and the real estate fundamentals that surround it.
Okay. And just curious, how do you view what's happening in the retail space and the Amazon and internet? What are you, as your REIT or your clients with the brokerage, how are they looking at that changing space?
There's definitely changes it's truly a paradigm shift in the way that we consume products these days. The more experiential type retail companies and tenants seem to be faring very well in this, or those who are embracing change are faring very well. Costco is the best example of this, where they have these, huge 150,000 square foot buildings, but they've also embraced a tremendous online presence, and their customers, who are just loyal to start with, love the fact that they can do both through Costco. And providing the Costco level of service is actually increased their revenues dramatically, and ultimately their stock price has gone up because of it, even though you feel as if they're a brick and mortar store solely. They've really figured out how to change their business model and embrace change. And those who are just refusing to do that are being hurt. I think
like the Blockbusters.
Oh, that's exactly right. Yeah, Blockbuster was an investment grade credit company. It was, and but they made great real estate decisions. So I could say the vast majority of Blockbuster stores that were vacated 10 years ago or so.
Good point.
They were backfilled is what we say, with other tenants that were just retrofitted for their very simple structure. Yeah.
What do you think the biggest opportunity is for a net lease investor when looking at deals today?
If you're willing to incur some risk in your portfolio, looking at assets that don't have the highest credit worthiness is probably an opportunity for some investors. But then you get into that entire risk discussion that we never had. But, if you don't need an investment grade credit tenant, typically you can get a few extra basis points on your cap rate, and that tenant may have a strong balance sheet, just not the strongest.
Right.
And that's built into the risk. So those are good opportunities right now. There's some pretty sophisticated dollars that are chasing those types of opportunities.
Right, and that goes back to investor profile. If someone has a strong enough balance sheet or enough liquidity, then I've had clients who they'd rather buy a single tenant franchisee fast food restaurant at an 8 cap, than get a big 300 unit operator at a 5.5 cap. Because they have enough wherewithal to do that.
Yeah.
So 3, let's say, client scenarios. If someone, number one, came to you and said, "Hey, David, I'm in a $10 million exchange. I have a $30 million net worth. I sold a piece of land that wasn't generating me any income." What kind of property would you put them in?
I'd probably ask more questions as to what they're trying to accomplish with that $10 million. How are they looking at any estate planning for themselves?
Sure.
Again, going back to our risk discussion, what are they truly trying to accomplish with their $10 million? Most people who sell land and haven't earned any income for most cases decades are just happy getting an opportunity to generate income with their proceeds. And so usually they're finding assets that are pretty conservative. I may go so far to say is very conservative, because they've gone from 0 to 4 to 6%, something in that range. And they are, happy buying, very high quality net lease properties. I typically would steer someone in that range, unless they're just a sophisticated developer type person, where they know that they can incur some more risk. And then we'd look at net lease properties that might have short-term leases on them, real estate, something that they can, just pay cash for. And then when the tenant/if the tenant does vacate, they would have an opportunity to redevelop that property or repurpose the property altogether.
And then on the flip side, let's say someone comes to you with under $1 million. So, let's say they have $1 million cash, not super high net worth, or even someone comes and says, "Hey, look, I have 50 grand, or 200 grand, with all the different things you've seen and what you're doing with Generation." What would you say to someone like that?
So the two scenarios you gave me, the $1 million or the $50,000, if they do have a true liquidity of $1 million in which they want to invest in a net lease property, I would say two things. One, you can buy a property all cash for roughly that amount, but it's just not going to be a very high quality property, and it's something that you have to be comfortable with the risks associated with that. And let's say that's not acceptable to them. I would then say, then you can go and get a loan and you maybe get a conservative amount of debt, 50% or so, and then you can get a higher quality property. But you then are taking on the risk of servicing debt. So those would be two options for them. If they have $50,000 or so, $200,000, I think was your other example. I would, of course, I'm highly biased, but I would say, try and pool your money with others. Pool your money with others. So, you can buy shares of the REIT, or you can buy a DST investment if that's what they're comfortable with. Something where you get some professional management, exposure to a lot of different assets, people who really know what they're doing, because in those price ranges, I would put my reputation on the line and say there just aren't net lease properties that can be purchased in those dollar ranges. Yeah.
Right. Yeah. And that's why I asked the question, because I think someone can get the benefits of triple net properties, but have someone who's, like a Generation or a DST sponsor who's professional and has the resources and the expertise to run the properties and run the portfolio, but then the investor can sit back and get Mailbox money and still get the benefits of the net lease sector.
That's right.
Cool. And the last thing we talk about on the podcast is triple net secrets. So if you had one or two triple net secrets that brokers or developers or tenants don't want an investor or a property owner to know, what would those be?
An investor, property owner. Well, in my case, they'll never get the proprietary algorithm, so that's kind of like an open secret. And I think just an investor's philosophy overall is, especially my investment philosophy overall, is somewhat secretive. And just because I feel like my experience level overshadows a lot of other lay investors, which just gives us a competitive advantage through a lot of different types of investment vehicles, whether brokerage or through the REIT. So I would say those are more open secrets than hidden.
Right. It's similar to the tenants. A lot of clients will say, "Hey, can you just call up the tenant and ask them what the store sales are, or why they picked the location, or find out if they're going to renew the lease." and the standard answer to that is they don't share that because that's proprietary to their business model.
Mm-hmm.
So
okay.
Cool. Well, David, I could talk for hours on this stuff, obviously. So I really appreciate your time today.
Me too. Very much so. Thank you so much for doing this.
Yeah. And if people want to find you online or connect with your companies, where do you want to send them?
Well, the REIT is GIP REIT, Generation Income Properties REIT.com, and the brokerage firm is the number 3-properties.com.
Okay, cool. And you obviously have a great LinkedIn profile with a lot of followers on there.
Yeah, it feels good to be popular, right?
Yeah, that feeling doesn't really go away, does it? From
right.
from when we're younger, right?
That's right.
So,
that's right.
Yeah, cool. Okay, David, we'll see you in Aspen hopefully this summer.
That sounds great. I'm looking forward to it.
Thanks for listening to the 1031 Exchange Passive Income and Investment Series. To help create, grow, and protect your wealth with 1031 exchanges and triple net properties, visit 1031navigator.com or call 1-866-539-1777. Again, call 1-866-539-1777. Make sure to remember to ask Thomas about our 1031 VIP program. You can put thousands of dollars in your pocket on your next 1031. If you enjoyed the show, be sure to subscribe, rate, and review it where your podcasts are peddled. And if you have a friend considering a 1031, make sure to share this show with them. A referral is the best compliment we can receive. Thanks for listening, and see you again soon. And remember, this show is provided for your informational and educational purposes only. Be sure to check with your accountant, lawyer, and/or other tax professionals and advisors before relying on this information. Although the information contained herein is believed to be accurate and reliable, we do not guarantee its accuracy or completeness, and it is provided without warranty. Common sense is the best practice.